Okay, let's go ahead and begin. You see the first screen there. My name is J Kahn. My website is jupiterpeakfinancial.com, and you also have my email there as well. Again, please feel free to ask questions. Before I start, a very special thank you to FX Street for having me as part of this one day, one topic today. This is one of my favorite topics to talk about, intermarket analysis and using ancillary markets, and I'll be defining ancillary as helping markets. So we're using other markets to help us develop trading plans. First things first, no buy, hold, or sell recommendations. This is for educational purposes only. Please read this disclaimer. I'll leave it up there for you to view for just a few moments. All right, and also I will be using a number of different platforms, and so again, those are not recommendations by any means. Please do your due diligence as far as finding out what broker is correct for your situation. Just a little bit about me. Some of you have been with me before, but I think it'll help to know my trading strategies and kind of a little bit about my approach to the markets. I started out where I didn't know anything about the markets. I wanted to be a ski bum, and why I put that up there is anyone can do it. So if a ski bum like me can learn it, and all of you can be successful in the markets as well. I started out trading very, very, very short term in the futures markets, being a scalper. As technology changed, gray boxes, black boxes, as technology also helped people move away from the various market centers, I had to adapt to various markets, various strategies, and various time frames. And since I was trading different markets for different reasons, that helped me to help others, because everyone out there who's listening today, all of you, have different account sizes, different risk tolerance, different approach to the markets. You're trading in different time zones. So that's where I came in. I could help people because I understood and could mirror kind of what people wanted to learn for their individual situation. So that's the consulting company, Jupiter Peak Financial, founded in 2008. Prior to that, I've been trading since 1998, so I've been consulting for about 4 years, and I've been trading for almost 15 years. My approach to teaching is I kind of take the whole macro environment together, and that's what we're going to be talking about today, using the macro environment as far as intermarket relationships, but understanding longer-term investments, understanding inflation, understanding economic policy. All of that is key, I think, right now in this economy. My trading strategies, I combined swing and scalp trading, as you can see there, into swalping. So that's kind of a word I like to use. That's kind of my bread and butter, is being in the Forex markets on a intraday basis, and pretty short term for the most part, depending on how fast the markets are moving. I use also Forex to hedge the markets, meaning there are relationships I'm going to show you between equity markets and commodities and foreign currency pairs, so I can use them on longer term trades to be a longer term hedge against a larger portfolio, long-term portfolio. I also use options, and options are great because they are used for growth, they're used for income strategies, they're used for portfolio protection. Not all of you may need portfolio protection. Not all of you may not be looking for income. Maybe you're more aggressive and want growth. So again, that disclaimer at the bottom, understand what each strategy is meant to do and the risks of each strategy. There are no free lunches, and obviously trading any option, any market out there, any strategy out there without being disciplined, without a trading plan, can cause a lot of trouble or damage to your account. Why do I teach? First of all, I enjoy it. I'm a social person, and obviously, as you know, sitting in your home office maybe can be a little bit boring, and you might not be interacting with people when the markets are slow, and you can kind of trade out of boredom. So trading can get lonely, and so I enjoy helping others. I enjoy talking with others. I enjoy getting to know others. It also gives me credibility. I'm not just a teacher. I've been trading, as I said, for almost 15 years. I also manage portfolios, so I have a various registrations. I now have a Series 3 registration as well, which is actually the National Futures and Commodities registration. So I understand, though, most importantly, fiduciary responsibilities, and that helps me when I work with clients. I really need to know a lot about them to be able to give them the right recommendations for their situation. So I take it very, very seriously. But most importantly, it's accountability. I like working with people because the more I'm teaching and the more I'm talking about it and the more I'm talking about the markets today with you, the more it opens my eyes to different opportunities as well. So it's kind of like I'm talking out loud as far as my plan to you, and it kind of slows me down and gets me to look at the markets maybe a little bit differently. Instead of just sitting in front of the markets and thinking about trade, 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 now I'm sitting in front of the markets and developing criteria and developing education, developing plans for you guys. And like I said, it just helps me. So I hold my traders to a high standard, and I also hold myself to a high standard of accountability. So where are we going today? Trading psychology. I always review this, whether I'm talking live in an event, in person, whether I'm talking in my daily market commentary, which I'll show you the link to, or whether I'm talking just for a few minutes in a quick post. Trading psychology always comes into play, because I think that without trading psychology, without approaching the markets with a mentally fit attitude every single day, I think that that can be the biggest barrier to your success. We'll go into fundamentals and we'll talk about the VIX, which is volatility. A lot of Forex traders forget what that means for them as it relates to trading psychology and as it relates to the overall approach to trading. And then we'll get into the technicals and right into ancillary markets defined, and I hope that I can show you a few ancillary market trading opportunities today. I think we'll be able to do that. We'll mention a little bit about your opportunity, and then again I'll give you those a review and drop in some resources for you. Again, questions at any time as I start to move into the analysis, both fundamentally and technically, are more than welcome. So you are the system. This is when people ask me, what is the Holy Grail? In fact, I just did a webinar recently for FX Street, and someone asked me, what's the Holy Grail? And I said, you guys know it. You guys know where I'm coming from now as far as trading psychology being so important. You are the Holy Grail. If you as a trader, you as an investor, understand what you're achieving for your individual account, your individual trade at that very moment, and manage it correctly, you have a chance to succeed. If you're realistic given your individual situation. You fit the markets, not the other way around. Do not make them fit you. You have to kind of say, this is who I am, and then I approach the markets for who I am, and I fit into the markets. And I just want to make sure that you should be able to define your trading personality, and that's where we'll go into showing you the strong resources in FX Street. So before I go into that and show you, and I switch the application, I'll just go to the next slide very quickly. So fundamental analysis. So first of all, FX Street, they provide a great amount of information. One of the things they provide is economic calendar, and I'll show you that in just a moment, as well as other fundamental analysis in there. This is just a gloss over. We're going to go deeper into fundamental analysis, but this is a gloss over. Right now, the key components of fundamental analysis are central banks all around the world intervening. Then also we have something called VIX. What is this intervention doing to volatility, and what does that mean for our realistic trading plans? So you should just write these down because we're going to go deeper into fundamental analysis, but these are just kind of the key components of it right now. With your trading personality defined and a sound understanding of the major macro fundamental drivers out there, then you can move to the charts and start to create trading plans. First, you understand yourself. Secondly, you understand the major drivers. Then you move to the charts. So I'm going to switch applications very quickly here. And I'm just going to move over to the internet very quickly. Okay, so I'll just pause a moment while we bring this up. So this is my page on FX Street, and obviously there's a lot of great collaborators that are going to be talking today and talking, at various times throughout the week at you that FX Street has put together. So take advantage of it. But again, I just did a webinar last week with a Q3 review and Q4 preview where we talked about some major fundamental and technical trends. So that's a great look at fundamentals that we've had and fundamentals going forward. So you can go ahead and link there. The other page that I mentioned to you, I'll just go to the home page here. this is the homepage for FX Street with all of your great fundamental analysis. All right, and so you could click on fundamental if you wanted to do that. If you wanted to click on news, you could do that and see all of the latest news. But lots and lots and lots of good information, all right, on here. So again, though, you need to filter it to your individual situation. So under fundamental, and then I slide over to economic calendar. Here's the economic calendar, all right, that they provide you. And again, why am I saying economic calendar? Because the central banks around the world are intervening and doing their announcements, you need to be aware of when they're speaking. All right. So right here we have Fed, Federal Reserve in the United States, Fed's beige book, and you get 3 exclamation points. So probably want to review that, when that comes out. Then we have Fed speakers. They're not high up in the Fed. If you saw Ben Bernanke, our chairman, then probably you'd want to be aware of that for sure. But as you scroll down, you get another one here. BOJ, Bank of Japan Monetary Policy Meetings. If you're trading the yen, you don't want to be trading the yen and forget about that. You want to be aware of that. Then you might see what they say. Then you react to it after. Going further down, again, what I'm looking for is the major speakers out there. So Draghi spoke yesterday over in the European region. So use this economic calendar. I like to sit down every Sunday night and look at the full week. And so I know that when I'm trading, in my trading hours, what's coming out. And I have it highlighted on my computer here on a Post-it note so that I know not to trade and forget about someone speaking that could greatly affect my short-term trade. And it could move the markets 50 pips, 80 pips, 100 pips, 200 pips right away, and I might only be risking 10 pips to make 20 pips as an intraday trader, and then I leave it to chance if I just put on a trade, forget that they're speaking, and then the trade kind of blows up in my face, or it could go my way, but that's more luck than anything, and we don't want to leave it to luck. So take advantage of this strong economic calendar, and you can go ahead and click on any of these economic events or speakers and learn a little bit more about them or review them if they happened and you just weren't around and then you came back at the end of the day to go ahead and review them. All right, so moving back into the slides here. So fundamental analysis, again, these are the key highlights of it, and you now know on FX Street where you can get information from me, information from other collaborators, seeing their archived events if you want to review them, and then obviously seeing the news, fundamental event analysis, as well as the all-important economic calendar. Technical analysis, again, we're going to go deeper into it when we get into the actual meat of the subject today, the ancillary markets. So this is just something for you to write down because I think it's important. If you understand the trend, and a lot of the times the trend is defined by fundamental events. What is the trend of the pair that you're looking at, and what is it defined by? Right now it seems to be defined by those central banks intervening. So understand which way the trend is going and what's driving it. The trend is your friend. That's an old adage. Understand key areas of support. Understand key areas of resistance. If you understand those 3 words, I think that you can be a safe trader. You do not want to trade in the middle where your risk reward is poor. That is something that I don't want you to do. I don't want you trading with a 1-to-1 risk to reward. You could be trading with a 1-to-2, 1-to-3 risk to reward, where your losers should be small and your winners, you let them ride, and they should be large enough that if you have 1 or 2 or 3 losers, your winners are still larger than those losers if you have a proper risk to reward because you're trading in the right location. Build trading plans with technical and fundamental reasons for entry, technical and fundamental reasons for stops, technical and fundamental reasons for your profit targets, all based on fundamentals and technicals. That is what a trading plan is. That's very, very important. If you don't do that, you're probably guessing. So getting into ancillary markets, I want to just define the word ancillary. What does it mean? It means helping. I'm using some other market to help me make a trade in the market that I'm in at that moment. I'm using the equity markets to help me make a trade in the foreign currency markets. I'm using the gold market that's closely tied to the Australian currency and their economy to make a trade in the Aussie US or whatever pair I'm looking at. I'm looking at the oil market to go ahead and make a trade in the USD Canadian because, as we know, the Canadian region exports lots and lots and lots of energy, and they're closely tied to oil prices. Not always. There's bigger things at hand, but the point is there is somewhat of a relationship there. So economic data going forward, as I talked about in my quarter 3 review and quarter 4 preview, could there be more intervention? Absolutely. If economic data continues to go south and be poor, then the central banks have said, we're here for you, we're here to help. All right, that's what the Federal Reserve in the United States says. We're going to continue to monitor data. They're not out of the picture by any means. So technicals, with that being said, now when we start to see economic data coming in, knowing that the central banks are there watching it, what are the technicals doing in reaction to all of that data? So now I want to start to move into trading ranges, trade frequency, and talking a little bit about that when I talk about VIX. So I'm going to show you the next slide, but before we go into the deeper into technicals and things like that, I want to go into VIX. Why is VIX important? Because the central banks are saying we're here to support the equity markets. Traditionally, when equity markets go up, volatility goes down. So economic data is, in fact, weakening. That's what you can get from my quarter 4 preview from that other webinar last week on FX Street. That's archived. Central banks just did a round of easing all over the world, all different central banks, and they're still there ready to do more, possibly. What does that mean for equity markets? What does that mean for the U.S. dollar? What does that mean for volatility? What does that mean for trading ranges? And a segue to technicals. So I'm using other markets, fundamentals for other markets, technicals for other markets, and then that helps me. So let's go and look at some other markets right now, and then technically we'll go into the Forex market. So I'm going to switch the application quickly. All right, so I'm just bringing up the charts here, and you should see the charts in just a moment. All right, so in front of you, you should have a platform. Again, no recommendations as far as different platforms out there. There are many different brokers, and again, I want you to do your due diligence. So what I want you to see is what the equity markets have been doing in response to QE stepping in. So this is SPY, and you can see that it's been trending up. This is a yearly chart. So every period on here is 1 day as you're looking at it. So every bar is 1 day. And as you can see, the chart has been going to the moon. Percentage-wise, from October last year to October this year, we were up about 35%. Okay? Big move in 1 year. Volatility, on the other hand, when equity markets go up, I said volatility goes down. This is volatility. This is a 5-year chart of volatility. 2009, we know, in 2008, the world was a lot different. Volatility was higher. Then things recovered in late 2009 and early 2010. Summer of 2010, we had volatility. Then late 2010, equity markets rallied. Volatility went down. Summer of 2011, same thing, a period of volatility, but late 2011, equity markets rallied. 2012, early in the year, equity markets went up, volatility went down. April, May, June, economic growth slowed, equity markets went down, volatility climbed. Late June, July, August, September, into October, equity markets rallied, volatility declined. Remember support. Where is support in this chart? Well, I think that you can see down here, support's right around the 13 level. If I bring this down to just the past couple of weeks, you can see that volatility has been bouncing off this 13 level and going up. Just a couple days ago, volatility bounced off this level and went up. What did the stock market do in that same time frame? What did the stock market do in October now? Just so that we can compare it. If I bring it down to just show you, here it is. We topped out in September. We backed off a little bit. We topped out again a couple days ago. We went down on late Friday, Monday, and Tuesday. We went down, and so VIX went up. So there's that opposite reaction. Overall, though, trading ranges are very, very, very small. These are daily bars, and we're moving up 10 points, down 10 points. And it was summertime, so there's some seasonality. But VIX is low. When the VIX is low, down in 13s, 14s, 15s, trading ranges are small. So I want you to understand that the VIX helps me to know, to really be able to forecast. I have a feeling that trading ranges here in the equity markets, they are small. Now I have to go and see what they're doing in the foreign currency markets. okay? So please clarify VIX. This is the first question coming through. And thank you for asking that, because I do have a feeling that lots of Forex traders don't focus on this. Again, I focus on multiple markets. I trade options, and the volatility gauge is a little bit more important to option traders because volatility is a component to option premiums. There's various components that go into pricing of an option, and volatility is one of them. So think of volatility as a fear gauge, uncertainty gauge, okay? So with that being said, the more fear and uncertainty there is around the world, the higher volatility should be. So and I'm just reading the panel. Someone asked 2 questions in Q&A earlier. Please use the chat function because that's the one window I have up. So if you ask some questions earlier, please type them in and I'll get them and use the chat function. So the first question is on the VIX. So I want to show you the relationship, okay? I want to show you that relationship, and that's what I'm doing right now. What is the VIX doing overall? Well, overall, you can see the VIX is declining. And in this same and this is a yearly time frame. And look at the same yearly time frame for SPY. SPY, the S&P index, is going to the moon. So even though there's fear out there and unemployment and the world growth is slowing down, this is key, you guys. The world growth is slowing down. That's what happened in April, May, and June. Equity markets went down. And nothing has changed in June, and July, and August, and September, and October. Economic growth has continued to get worse around the world, and the stock market has gone up because central banks have intervened. So the stock market is going up in the face of all of this bad stuff going on around the world, and in turn, what is volatility doing? It's going down and down and down and down and down. So volatility is directly related to the conviction of traders, to the participation of traders, and to the amount of trading going on. All right? So it means liquidity. It means movement. It means opportunity. The higher the VIX is, to me, the more opportunity there is. The lower it is, the more patient I have to be. I love being a day trader. I may not trade every day. Is there an advantage? So someone else is asking a question, is there an advantage to trading futures as opposed to currencies? Futures are just a little bit more leverage, so as long as you have the account size, that's what you want to focus on, making sure that you're not over-leveraging, over-risking your account to trade something that you don't have the account, the buying power to do. If you have a stop-loss debt limit, there's another question, set for your futures account, will that stop from extreme money loss? There is no guarantees anywhere. In the markets, things can gap. I don't care what market you're trading. So your Forex broker, for the most part, will stop you out. They have the power to stop you out, but it can still happen after you took a bigger loss than you thought. So you've got to manage things. Usually 1 to 2% is the rule, you guys. This is trading psychology. Do not risk more than 1 to 2% of your account on any one trade. Now, if you have a $10,000 Forex account, but you have a $2 million equity portfolio, then you can risk maybe a little bit more than 1 or 2% of your $10,000 Forex account because you don't have just $10,000. You have $2 million in $10,000. So then you can have, then obviously you can define that based on your individual situation. How can one lose more than in an account? Options have risks and obligations. Futures can go forever and ever and ever, and so you have to be very careful, and we're not getting into, obviously, we're staying on ancillary markets here, and we're going to trading markets defined. So, again, if you have questions on which accounts are right for you to trade, that's where I'll show you there's an opportunity to, bounce some ideas off of me. So let's keep that, since that's more of an individual question for your account, let's keep that, if you want to get in touch with me, aside from this webinar, you're welcome to do that. So I think you guys understand now what the equity markets are doing and what VIX is doing. Now, and I'm just going to go back into our, and now what we're going to do is go back into the PowerPoint slide so that I can show you where we're going as far as into Forex markets. Now that you have an understanding of what the trend has been in volatility, what the trend has been in equity markets. All right, so fundamentals going deeper. Economic data is still weakening around the world. QE3 is still just happened from central banks and could happen in the future. Equity markets are going up until just a couple weeks ago. VIX is going down. Now let's look at what the USD is doing. But overall, when the VIX is down, all trading ranges get smaller. Futures, Forex, options, equities, commodities, whatever it is, they are going down. That now helps me build realistic trading plans. So going into the next page, technicals, going deeper. Let's start to look at trading ranges. Let's use trading ranges to build realistic trading plans. Trade frequency, I can tell you right now, you should be trading less in low volatility markets than you do in higher volatility markets. Is it true that a chart is a chart for all markets? Yes. Once you learn to read charts, you just learn the nuances of that market, but you can apply your Fibonacci's, your moving averages, your double tops, your double bottoms, your head and shoulders, your pennants, your flags. Everything is all the same. So once you learn to trade one market well, and read technicals, you can trade, for the most part, any market. And that's what I'm telling you is we're using different markets over here in their technicals to help us with our markets. So let's go right into our Forex markets, because that's why you guys are all here, right? All right, so here is the 6 U.S. majors, all right, and I have some others down below if we need to get into them, but the pound versus the U.S., the euro versus the U.S., the Aussie, the New Zealand, the U.S. Canadian, and then the U.S. Swissy. So let's just look back in time here. When the equity markets were falling off early this summer and there was some volatility, okay, what was the trading ranges? Look how big these bars were. Look at these bars and the size of the daily trading bars. Then equity markets recovered, and in June, equity markets went up. July, they went up. August, they went up. September, they went up. And you can see the bars got a little bit smaller, all right? So when equity markets went up, volatility went down, the bars just became a little bit smaller. And if you look back on a longer-term chart, look at the trading range here in 2008 and 2009 when the world was falling apart, and look at the trading ranges since then, because in 2009 the equity markets went up, in 2010 they went up, in 2011 they went up, in 2012 they went up, and look at the trading ranges now. Look at the overall trading range for the Great British Pound and the U.S. dollar over the past 3 or 4 years. For the most part, it's been 64-ish, 1.64 to 1. Let's say 50-ish. It's been 14 pips. Or 14 pennies. And lately, it's been even tighter. It's been about 62 down to 52. It's been about 10 pennies. So we're in a big range going back and forth, back and forth. We just hit the top of our range. Look at this. We went from 62 to 52 and back up. Look, what did the pound do in April and May and June when the stock market went down? Pound got killed. What did the pound do in June, July, August, and September when equity markets went up? It went back up 10 pennies. What did the euro do during that time frame? So here we are looking at the euro. April, May, and June we went down, and then July, August, September, October we went back up. Now we're starting to see a little bit of action here, but for the most part, trading ranges have been smaller. VIX has been lower, equity markets up, and there's a relationship between equity markets going in one direction and U.S. dollar going in one direction. So I'm just going to go back to, I'm going to answer a question and go back and show you a trading opportunity in a couple different currency pairs, because that's why you guys are here. Are traders discouraged or worried because markets aren't giving that much lately? I would think that I'm talking to old trading friends in Chicago. I'm talking to people all around the world that I kind of keep in touch with. Absolutely, it is sad to say that central banks and governments have stepped in and provided help to the equity markets, which is providing a lower volatility. And yes, there has been less potential recently. So absolutely, I believe that you should be more cautious as a trader in these markets due to the volatility, due to the intervention. So yes, they have stepped in and they have affected it. There is still opportunity, don't get me wrong. There's still a lot of opportunity to make money on your money, versus in real estate or in bonds or other places. But, and the equity markets have also done well around the world, certain regions. But yes, overall, I think that people should be taking the markets differently now as traders in these low volatility markets. So that's a very, very good point. And that's the whole point of trading psychology and understanding what's going on fundamentally and with the VIX. So let me just jump back into the application here. All right, so intraday trading ranges, we talked a little bit about them, and I want you to make sure that you're using VIX and using this charts to build realistic trading plans. I want to define an ancillary market trade for you. Economic data around the world is weakening. What have the equity markets done in reaction to QE around the world and central bank intervention, and what has a market like oil done? Because oil we can relate to the United States dollar and the Canadian dollar. So let's look at various tops and bottoms in these markets, okay? And then I'm going to show you a date that the stock market topped out and all the USD pairs topped or bottomed out. Okay, so here we are. Actually, you know what? Let's go into the equity markets first. Okay, so here we are with the equity markets moving up and up and up. And QE happened right here. QE happened on the 13th. On the 14th, the stock market topped out. So we had this huge run. But this run was caused by bad economic data, worsening fundamentals around the world, and so we don't need as much resources. We shouldn't need as much commodities if more people are getting laid off, if jobs data is worse, and the economy is getting worse, okay? So now, in relation to that market, I'm going to bring up USO, which tracks oil prices. So here's your ancillary market. What is USO doing? USO oil prices, if you wanted to watch oil prices, they went from 80 to 105. USO, which tracks oil prices, went from 29 to about 37. What day did they top out? Stock market topped out on the 14th. USO topped out on the 14th. It hit 100 this day. USO hit 37. Oil prices hit 100. All because fundamentals around the world that say we need less energy and less oil because we're backing off. We don't need as much in a bad economy. And in that time frame, USO went from 30 to 37. $7, that's more than 20%, you guys, in 2 months, 3 months. That's huge. So the stock market topped out. Oil hit 100. USO hit 37. Now, let's go look at our currencies. Let's go look at the U.S. Canadian. Remember that date, the 14th, you guys. What day did the U.S. Canadian bottom out? 9/14. The United States dollar hit support. USO hit resistance at 37. Oil prices hit resistance at 100. Stock market stopped going up and went down. Oil prices, if you were an owner of oil or oil companies, you would be very happy, but you would be saying it can't keep going if the stock market, if the fundamentals around the world are saying we need less oil, less oil, less oil. The only reason oil is going up is because the stock market is going up on QE hopes. QE happened. Now it happened. Economic data is still getting worse. It can't continue. And so you could start to see maybe a place to, when that happened, you didn't have to nail it this day, but even if you got in a day later or 2 days later and you got in at not just 96 down here at 96.20, but you got in at 97, 97.20, 97.30, that might be a short-term trade, a longer-term trade. You could use it as a hedge if you own lots and lots of oil or oil companies or whatever it may be. So that's that relationship. The U.S. dollar turned around the day the stock market stopped going up, the day that oil prices stopped going up. That's that intermarket relationship. That's why knowing what other markets are doing is really, really, really helpful. So someone is talking about VIX. Remember, I've reviewed VIX. I think we spent a lot of time on it. VIX means uncertainty, fear, and anxiety. And the higher it is, the more fear there is. The lower it is, the less fear there is. And it's very low right now. And if there's less fear, there's less conviction and participation on the part of traders, and that means trading ranges are overall smaller. So let me just show you another ancillary market trade. I want to show you one more before we finish up today. So ancillary markets trade defined. Use the fundamentals out there like economic data. Use percentage moves in other markets to help you. So we just looked at, and I didn't show you, but all USD pairs bottomed or topped out, depending on which way they're going. But the USD hit support on the 13th or the 14th when the stock market also topped out. So just so you know that that actually did happen. All right, so one more trading opportunity I want to show you, because this is happening a lot right now because we're getting a little bit more volatility. Still not a lot, but a little bit more. Let's go in and let me show you the stock market on a much shorter term time frame. So here's the S&P, and for all of you that love chart patterns, okay, go ahead and you guys can answer if you guys want. What chart pattern does this look like right now? You have one top here, it goes down into the trough, and you come right back up here, and you have basically a second top. So it could be a double top. We don't know, but if it's going to be a double top, the rest of the M, it's an M pattern, is going to go down here. So here's your support level. But more importantly than that, if economic data is getting worse, if QE already happened, and QE happened right here, then you can start to look and say, how much further can it go? We've had huge runs percentage-wise. So I'm going to draw you a quick trend line. So here's my trend line connecting the tops this is the stock market. This is the S&P. So we came up, we popped up, and then after QE, economic data is getting worse and worse and worse, and we back off, and we go up. So this is your old resistance line is becoming new support. It supported it here. It came back down, and it's support right here, and now we're starting to go through it. So the S&P is going down. If I told you that when the equity markets go down, that the U.S. dollar gets stronger, what do you think is happening to the U.S. dollar right now in the past few days as the S&P has gone from 147 to 143? $4 down of $147 stock in a few days is 2.7%. 2.7% in the stock market, not a lot, but in leverage products, that might be a lot, okay? Flight to safety. So Don said flight to safety, making the USD stronger. Don, let's go look at the USD. Okay? Here's the Euro USD. Remember, we double topped in the stock market. Kind of a double top. Not perfect, but pretty close. Here is that date where we topped out after QE on the 13th. Stock market went down. Stock market rallied back up. Euro failed and couldn't make that higher high. Here's that Fibonacci. And now the euro is going down, and it's right at, just like the S&P is at that support line of the trough, here is that same support line right there in the euro. And if the stock market keeps going down, you should see this weakening. So as the stock market failed up there and starts to go through its support line, 1.3060 down to 1.2820, so 2.5 pennies a move down. So could you see that relationship there? If you were bearish the S&P as it hit its resistance up there and kind of double topped, could you get short the euro when it was overvalued up here using using your Fibonacci's, using some kind of technical or your trading plan? But even if you put in a trade here and your stop up here, that's your risk, is you get short at 30.60 and you put your stop at the new high up at 31.80, so 100 pips you risk. And this is a longer-term trade. Short-term traders may not have the buying power to risk 100 pips. And you want to risk 100 pips to make 200 pips, and there you go. And maybe you leave a couple contracts out, and if it breaks this, and the S&P can break its support line, and it goes down, maybe you get a move down into the 28s, 27s, and you have a nice winner. So now you're kind of managing it. You might throw a trend line on here. Let's bring this down to a 1-hour chart. Maybe you're kind of watching the resistance areas. If you're short, maybe you're doing something like that, and as long as it hits this and uses that resistance, you're fine. So your stop, if you got in here, you move your stop down here. Now that it moved down here, you might put your stop down here. So you're managing the trade. Always, always managing the trade. So keep in mind, as I said, the stock market did top out on the 14th, and that's when the dollar started to strengthen. Here is the 14th of September right here, and the pound has been actually weaker than the euro. The pound has been going down a little bit more, 62.80 down to 59.70. So about 3 pennies as it moved down. Okay, but they all did it on the same day. I showed you that U.S. Canadian on that same time frame. Low 96 is 97 up to 98.99. Nice move up. Oil went 100, 99, 98, 97, 96, 94, 93, 92, 91. USO went 37 to 33. Nice 10% move in oil, 10% move in USO, and a nice 2-penny rally from 97 up to almost 99 in the US dollar Canadian. That's how you use fundamentals. That's how you use other markets to help you trade the Forex markets. So let's go back into our platform here, the PowerPoint presentation. Okay, so ancillary markets trading defined, kind of long-term and short-term, we're seeing what's happening with equity markets and the US dollar. Your chance. My website, JupiterPeakFinancial.com. I talk about you being the system. I offer a free, no-obligation engagement interview where I ask you questions about your account size, how much you want to risk of your account per trade, your trade frequency right now. If you're new, you might not have a trade frequency, but you're not sure how many pips to risk given how often you're in front of the markets and what time frame you're trading as far as time zones and where around the world. So I go over all of these and I give you a nice Word document that explains everything, and then I kick it back to you. Again, I don't sell you anything. It's free. It's no obligation. It's my unbiased opinion and summary of what you can achieve out there in the markets. So just a quick look at the website here. It's JupiterPeakFinancial.com, and so you can find me there. I provide daily market commentary, but that daily market commentary also gets kicked over right over to FX Street where they copy it in there. So you see my daily market commentary right on FX Street. But if you have any questions, you can go to my site, JupiterPeakFinancial.com, and ask any questions that you have. Like I said, the person asking questions on their account in Forex spot versus futures, I can help you with that as I kind of give you my opinion of what I think is right for you given your situation. So going back into I told you we would wrap up with a review and then resources. You learned about me and my approach to trading, my approach also to teaching. You learned that trading personality is the number one, barrier if people don't understand that to success. So please be honest with yourself and your situation and filter the information that you're taking in for your individual trading personality. Fundamental analysis, use volatility to be realistic. Technical analysis, keywords, trend, support, resistance. Then use ancillary markets, equity markets, to go and trade our Forex markets. What is the equity markets doing? What is the volatility doing? What then are my trading ranges and my trading relationships with my Forex pairs that I'm looking at? And then obviously you learned a little bit about your opportunity if you're interested in talking with me on that. If a ski bum can do it, that's the first slide I showed you. I wanted to be a ski bum. I met a trader. I didn't even know what trading was. If I can do it, you guys can learn this. But it takes time. It takes discipline. It takes focus. It takes hard work and experience. Give yourself that chance. Don't come into the markets with an unrealistic expectation and blow your account and then say that was a terrible experience. Come in with realistic expectations. You're competing against very savvy people all around the world, and they want to take your money if you come in and guess. This is not guess. This is not a gamble. I get very, very, very perturbed and upset when people say, oh, you're a trader, you're a gambler. There is way too much work that goes into making a trade to call it gambling. Allow yourself to gain experience by trading correctly, given an understanding of your trading personality. Resources, my FX Street profile and all the great contributors there. My regular market commentary that goes onto the FX Street profile. There's the website right there. I have about 30 different recordings I've done for brokers. Again, not a recommendation by any means for any brokers, just I do education for different brokers out there. So you can go to my website and click on the link, or you can go into YouTube and go ahead and search for the Locals Take. But there is a link on the website. And then obviously take advantage of those one-on-one engagement interviews to find out what you as an individual can achieve, handle, and focus on as a trader and investor. And then you have my email there as well. So let me just see if there's any questions to wrap up. So there it is. You have my email if you have any questions. How do we know which market leads which market? That's a good question because sometimes Forex markets do lead it. But if you're paying attention to multiple markets like this, you'll start to see it. So by all means, you may be right. the Forex markets led first and they topped out or bottomed out, and then the equity markets moved. But that's what I'm saying is, why limit yourself? If a chart is a chart is a chart, why limit yourself to just foreign currencies when you can take advantage of leveraged products using options or commodities or other things? All of these markets are interrelated, you guys. You need to understand that, and you need to use it, because then you can move from one market to the next very seamlessly. And that's something that I'm huge on, is, as I said, I manage portfolios. I use options for different strategies to hedge, to create income for growth. I use Forex for growth. I use Forex for hedging. I think that you guys can get there, and that's what I write every single day on my market commentary about these relationships, and definitely about, those relationships on a short term and a long term that help you. So ancillary markets are so important. So thank you guys very, very much. Thank you for FX Street for having me. Please see some of my archive information on my profile on FX Street, and I'll look forward to talking to you guys again in the future. So this should be live pretty soon. FX Street, you see them in the chat function typing that out. So again, thank you guys, depending on where you are around the world. I appreciate your attendance, and I do appreciate your participation. That's what makes it a really, really fun webinar, is when you guys ask questions. So happy trading and invest intelligently.